Okay, let's jump right into this explainer and unpack a massive, fascinating mystery surrounding MSCI. Now, if you follow global markets, you already know MSCI. They basically provide the critical data language that massive financial institutions rely on every single day. But recently, this data giant presented us with a wild contradiction that we absolutely have to explore.
Right off the bat, think about this paradox. On one hand, MSCI just celebrated a mind-blowing milestone. The exchange-traded funds, or ETFs, linked to their data just surged past a staggering $2.8 trillion in assets under management. That was driven by nearly $40 billion of inflows in the second quarter alone. But despite this absolute flood of capital, the market's reaction was brutal. The stock took a sudden, painful 10% plunge, dropping down to $561.74 in a single day. So, how on earth does a company win so big on their actual product, but take such a massive beating on the trading floor?
Part 1. A high-margin engine. Let's lift the hood on MSCI's financials.
To really understand this company, you have to look at this number, 59.3%. That is their adjusted EBITDA margin from the first quarter of 2026. If you're familiar with EBITDA, you know it's a great measure of pure operational profitability. And honestly, pushing a 60% margin proves this company is just an absolute cash machine. For practically every dollar coming through the front door, a huge chunk of it drops straight to the bottom line. And what's really wild is the absolute growth powering those margins. Total operating revenues jumped 14.1%, hitting over $850 million. But zero in on that middle row for a second. Look at that massive 26.6% spike in asset-based fees. So while their recurring subscriptions are growing at a very solid 8.6%, it's really those asset-based fees that are just skyrocketing right now.
So what exactly are these asset-based fees, or ABF? Well, think of it simply as MSCI taking a recurring slice of that massive ETF pie. As the assets tracking their indexes grow, their fees grow right along with them. That run rate has hit a record $948 million, which is up 25% year over year. They are essentially clipping a ticket on trillions of dollars of global wealth.
Moving into Part 2, breaking down the segments. Where does the money actually come from?
When you slice up their Q1 2026 revenue, the index segment is the undisputed heavyweight. It makes up 58.3% of their total revenues. That's nearly $500 million in just one single quarter. It is the absolute cash cow. Analytics comes in a distant second at 22.3%, and then you have their newer growth areas bringing up the rear, sustainability and climate, followed by private assets.
You might be wondering, how do they keep growing that massive index segment? Well, they aren't just sitting back relying on traditional asset managers anymore. They are aggressively going after hedge funds, and it's working. Recurring net new sales to hedge funds literally tripled year over year to $8.6 million. And as CEO Henry Fernandez pointed out, we aren't talking about small mom-and-pop shops here. They are successfully targeting massive, stable, multi-strategy platforms. Throw in a 23% organic growth rate in custom indexes, and you've got a core business firing on absolutely every cylinder.
But when we step outside that core index business, things get a bit more complicated. It's a real mix of signals. Private assets are growing beautifully, subscription run rates are up over 16%, heavily boosted by a brand new strategic partnership with UBS. But check out that final point. Management is actually expecting 0 to slightly negative net new sales in the sustainability segment over the next 2 quarters. The whole ESG narrative, which was a massive tailwind just a few years ago, is facing some serious market pushback right now, particularly over in the Americas.
Part 3. Why did shares fall? Let's unpack the market's reaction.
So bringing us back to our big paradox, why the 10% drop? The market basically got spooked by a few specific things. First off, there was this unexpected softness in analytics margins. Management said this was mostly due to higher compensation accruals, just paying their people. The CFO even brushed it off as just quarterly lumpiness. But here's the reality. Wall Street algorithms absolutely hate lumpiness. Combine that slight margin dip with the flat outlook for ESG sales, and the warning lights just started flashing. But honestly, here is the real reason those warning lights triggered such a violent sell-off. It all comes down to the valuation premium. With a price-to-earnings ratio sitting over 30 and an enterprise value to EBITDA multiple over 22, MSCI stock is priced for absolute perfection. In plain English, Wall Street expects them to be flawless. When a stock trades at multiples this high, any tiny hint of softness, like a blip in analytics or a cautious outlook in sustainability, acts as an immediate trigger for a pullback. There is simply zero room for error built into a price tag like that.
Finally, Part 4, Betting Big on the Future. Let's look at management's aggressive counterbet.
Instead of retreating or getting defensive, CEO Henry Fernandez is looking at this landscape and seeing the early innings of a massive new growth cycle. I absolutely love this quote from him. He says, "Given our conviction in our franchise and the growth prospects that we see, we're prepared to put a bid on the other side of that trade." He is basically daring the doubters. Management is putting their money right where their mouth is, looking at the 10% sell-off and treating it like a massive discount on their own stock.
And they aren't just buying back stock, they are building the future at lightning speed. They've totally accelerated their product pipeline, shipping over 80 new products in just the first 6 months of the year. To put that into perspective, that's double what they launched in all of 2024. They just opened a dedicated AI office right in Silicon Valley, and they are aggressively expanding into active ETF data products. They are making completely sure they capture the next big wave in asset management, not just resting on the passive index wave they already dominate.
And while they are innovating like crazy, we can't forget about that fundamental financial strength we talked about earlier. This company generates so much cash. Even with the market jitters, they are constantly returning huge amounts of capital to shareholders. We're talking $150 million paid out in Q1 dividends, a declared $2.05 per share for Q2, and of course those aggressive share buybacks, where they scooped up hundreds of millions of dollars of their own shares at a discount.
So, wrapping up this explainer, you're really left weighing two colliding realities. On one hand, you have incredible proven cash flow, total market dominance, and a hyperfast pivot into AI and new products. But on the other hand, you have a premium valuation that ruthlessly punishes any imperfection alongside some real headwinds in their sustainability sector. So, thinking about those trillions of dollars in assets they track, I want to leave you with this question. Who is ultimately right here? Is it the panicked market that wiped out 10% in a single day? Or the aggressive management team buying up their own stock, convinced they're just getting started?